Hello and thank you for checking out today's market update video. Today is Tuesday, August 27. It's about 11:15 a.m., so we're not quite halfway through the trading day. Today I wanted to update a video I posted last week, and you may recall this chart is one I commonly use. This is a one-year chart of the S&P 500. It's a daily chart, so each of the bars you see on this represent a trading day. And the red bars indicate a day the market is down, and the solid color, kind of white bars, are the days the market is up. As of today, the S&P is down just about 1%, and you can see that's the last bar on the far right. The things I want to point out are kind of what to look for in terms of, is this latest decline, is it just going to be something very small and modest before an uptrend resumes? Or if it's not, how far will it go down before it finds some footing, at least based on what we've seen the last few years? So one of the things that I did draw in onto this chart that has not been on ones in the past is something called the 50-day moving average. And it's this kind of really thin line we see at the bottom here. And you can see that just about 7 days ago or so, the S&P 500 broke below that 50-day average. And this might not mean much to the average person, but there's an awful lot of traders out there, institutional traders, that is, that they do trade on technical measurements that really take a look at the strength of the market, and they'll take long positions or sell off, and sometimes take short positions based on where they think the shorter term trends of the market are heading. This is really regardless of the fundamentals of the market. They just trade to try to make a profit. And because of their trading, it creates sometimes, big rallies that are wonderful for long-term investors to be part of, but also can create some pullbacks that are not so wonderful. They can be rather painful. So what we see right now is one of these pullbacks. It's a market that's pulled back down to around this 50-day average. And the reason this is fairly significant is really in the past year, we can see that this big rising channel, which was the big rally that stock investors in the U.S. enjoyed from November of 2012 until really up until just a few weeks ago. Every time the market would have a small pullback, it would pull back to right around that 50-day average. We can see that happened in December of 2012. It happened again in March of 2013. Happened again in April of 2013. Fairly recently, it happened in sort of early June. And one time it did fall below that 50-day average. Only stayed down there for about 5 or 6 days before then moving back above it. So what it's doing right now is just recently it fell below the 50-day average. It tried actually yesterday to go back above it, only to fail. And today it's done what's called a gap down, which means that the market's open was quite a bit lower than the close from yesterday. So there's a gap in between the two bars there. Now, it's still a little too early to see if this 50-day average is going to be sort of a detriment, but if we take a little bit longer view, so the next chart I'm going to show you is an S&P 500 weekly chart. So now each bar represents 1 week. The blue line that's trending up is that same 50-day average. And this is now looking at 3 years, so a little bit more intermediate time frame. And when we take a look at this, we can kind of see again what I just noted, that since the end of 2012, this latest rally, every time the market's gotten close to that 50-day average, it's mostly just bounced off from it. But if we look a little bit longer term, we can see that when it does fail, like it did in 2012 twice, it went down to this red line, which is the 200-day moving average. And moving averages, as the name sort of implies, it's just the average price of the market for that time period. So when we say 50-day, it's the average value or the average price of the S&P 500 over the past 50 days. And the same is true when we talk about the 200-day average. It essentially is the long-term trend of the market. And so we can see that when it's failed to stay above the 50-day average, the last 2 times it's happened, it went down at least to the 200-day average before bouncing and resuming the uptrend. So as far as what could happen here in the short term, well, I think that if it doesn't bounce off this 50-day average like it did just a couple of months ago, the most likely scenario is it should at least test its 200-day average. When it does test that 200-day average, and if it happens to fail, that's what happened back in 2011. You can see the market had a really, if we go all the way to the far left of this chart, it had this nice rally, was bouncing off the 50-day average, ended up failing, falling through that, and then and in this case actually fell substantially below the 200-day average, creating a 15+% decline, actually more like from the absolute peak to the absolute trough, almost 20% decline. So we have to watch all these different things very closely, only because of how they impact us psychologically. We do know that if we have a very, very long time horizon, markets do tend to go up, but they do have corrections in between those good years. And this year has been kind of an unusual year in the sense that the only market that's been good all year has been the U.S. stock market. I've talked about that or written about it on my blog, in that international stocks and commodities and real estate and bonds, everything else is negative for the year 2013. So part of the reason why I've not been a huge believer in the U.S. stock market rally has been because it sort of decoupled itself from the rest of the global financial asset classes. And for it to sort of revert back to a mean would be very much expected. If this was to happen and the market was to fall down to that 200-day average, more than likely we'd see something in the neighborhood, in the S&P that is, of about 50 to 100 points. It all depends on how fast the decline happens. If you can understand the way math works, if it happens fairly slowly, then the 200-day average price starts to slowly go down as well, which means that it could be a further decline. If it happens sharply, it'll hit that 200-day average relatively soon. And as far as which one it could be, it's hard to say. But that's what I'm watching, at least in this sort of short to intermediate term time frame. And really to couple all this together, we're just about finished with the month of August, and September, I'll write a post on it just so everyone has the statistics, but September is historically the worst investing month of the entire calendar year. So if we had to look at seasonality of which months are the worst, I'm sure a lot of people have heard of sell in May, then go away. So a lot of times summer months are not that great. That has not been the case this year. The market's right now roughly the same value it was in May, so it hasn't necessarily been hurtful to be invested. But September's coming up. It's right around the corner. And September is historically the worst performing calendar month. So if we're going to have a correction, it would be sort of interesting that it would happen right as the market's struggling with this 50-day average. There's also a lot of economic news and Fed news coming out in the next couple of weeks. And we're heading into one of these months that, again, historically is not a great month for investors. So stay tuned. I'll keep everybody up to date. The good news, if you've been following our tactical asset allocation updates, you'll know that we're not heavily invested in the U.S. stock market, have a fairly balanced, even conservative approach. And so this last few weeks when things have gotten dicey, if you have that balanced to kind of conservative, globally diversified portfolio, this has not been nearly as bad as if someone's just been in the stock market and bought in late. Most people have heard the saying that you want to buy low and sell high, but a lot of people chased the stock market. They saw how much it was up this year and they just started buying in, sort of in the last couple of months. And we know that because the volume has been slowly deteriorating. So there's been less buyers as the markets rally, which means that smaller individual investors are the ones that have been buying at the end of this rally. It's not been the bigger institutional investors. Consequently, that's also a telltale sign of a correction looming. The big investors are just waiting for the small investors to drive the price up as high as possible. Then they start to bail, lock in their gains. And they hope that the small investors get frustrated. They then become the last sellers in a decline before the big investors sweep back in and buy up some more shares. So don't want to get caught in that routine. It's a pretty deadly process of buying high and selling low. Instead, you want to have a good plan, stick with that good plan, and just know what's happening via looking at the charts and following the economic data, two things that I try to make sure are published here on my blog frequently. So hope everybody has a good rest of the week. I'll be in touch and keeping things up to date, and also have our economic update going online this week. So I'll give everybody a heads up as far as economically how things are going via our recession probability analytics. Until the next post, again, thank you for checking out this one, and have a great week. More than likely, I'll be online posting at least a couple more times between now and this Friday, just a few days from now. Take care.